Well, the financial markets all week have been focused on crude oil. That's unlikely to change. This is Tom Aspray with the Viper Report Market Wrap video for a look at last week's war hits the markets. This chart, many of you have seen before. I've been featuring on and staying really out of crude oil or the energy ETFs for most of the last, or at least since 23. I made a couple of failed attempts that resulted in generally small losses or small profits. We got back into XOP a couple weeks ago, and crude oil, you can see, is now quite extended, well above the Stark band here. The upper start band is at 90.79. We closed at 91.27. And we're looking at the 95 area as the next level of resistance. Of course, and this is without any serious problems yet in the Straits of Hormuz. Similar to what happened in the Gulf Wars, they started bottoming a week or two ahead, and so we have to see what happens here. This is a relative performance of crude versus the S&P. So you can see that this peaked in 22 when gross stocks started their correction, and it's been in a downtrend up until a few weeks ago. So crude is now clearly outperforming the S&P. It was quite the week for the financial markets. You can see this is the weekly performance. The big loser was transportation. No surprise given its dependence on oil. Dow was down 3. NASDAQ 100 held up a little bit better, 1.27, a little over 4 for the New York Composite. That was double the loss of the S&P 500. Utilities is down 1.9%, gold down 2.2%, and the small cap IWM was down 4%. Looking at the sectors, I added Hack in there, which is a multiple leveraged software direct-in product. It was up 6%. XLE was up 1%. Everything else was pretty much lower for the day, led by, as I said, the S&P was down 2%. So utilities and consumer discretionary were down a little more than that, as was gold. Real estate, XLRE. Interesting, the IWD, that's the value, down 3.4%. We're kind of looking for a rebound in growth and a pullback in value, so we're getting it. Some of the popular XLI industrials down 4%. Healthcare, we've had them twice, down 4.7%. Consumer staples even down 4.7%. And the materials hit the worst, down 0.6.7%. There were several days of heavy selling last week. You can see on Friday, 606 advances, 2174 declines. About the same on Thursday. If we look for the week, it was moderately one-sided. So there were 727 advancing stocks, 2100 declining. NASDAQ was about 2-to-1 negative. And if we look at the daily count here, we can see that the new highs are slightly less than the new lows at 64, but so far we haven't seen the surge in new lows that would be expected with a market turn. Let's look at some of the other averages. This weekly chart of the NYSE composite shows the major lower close down 4.2%. All the weekly AD lines, this is the NYSE all and the stocks only, have both turned down, as has the S&P 500. No divergences at that last high, and also they're still above their moving averages and therefore positive. We look at the daily for the S&P Spider. pretty ugly. We've had the 20-day EMA has dropped below the 50-day, and we closed well below the 100-day moving average. Looking at the QQQ, see it's another close slightly below the 20-week EMA with the pivot down here at 550. So 50 points roughly below where we closed, 10%. Do I think we're going to see that sort of move? I don't really think so, but we'll play it to see particularly how the weekly AD lines fare in the next week or two. You can see the NASDAQ 100 is still clearly positive, and no real with longer term support well below the market. The RS actually has risen and is close to turning positive by moving back above its moving average. So, if this is a growth going to lead the way versus value, then we would not be surprised to see a positive RS reading. If we go back, you look at the daily chart, you can see it was pretty ugly. Why the pivots are so important. Even on Wednesday, we closed below both the pivot and the 20-day EMA, and gapped lower here. AD lines bucking the trend clearly. I mean, if you had this sort of formation, then I would be telling you, well, we'd be looking for a pullback into this support level where I'd be a buyer. The price action does play a role. You can see we're once below 591 here. There's next support at 579, and we did close the week again below the quarterly pivot. So that's not a good sign. RS has improved slightly, but still, we'd really like to see it get above this downtrend to say that the Qs are again leading the market. You can see this chart of the weekly chart of the Russell IWM. Negative. It closed below the 4-week low here, 350. So we've got support starting, right around in the 345 area down to 230, which is the 50-day moving average. 200-day moving average, quite a bit lower at 199.75. We look at the SPY. We get more selling this week. We'll probably start to see, some people talking about the 200-day moving average, but you can see it's quite a ways below the market at 503.57 here. MACDs are negative on both those averages. Back to the daily chart, you can see that all the AD lines, daily have closed negative. Let's look at the S&P first. Closed below its moving average. It's starting to flatten out. Now, whether this is the start of a major correction or just the early warning sign, either is possible. Support right in here. So if we get a strong rally sometime in the coming week, strong being 3 to 1 positive AD numbers, that'll be enough to flip this back above its moving average. If that happens, then we'll be looking at the pivot up here, 686 and 688 for the 20-day. And similarly, you can see the stocks only, which typically in a correction is weaker. The all down here has bonds, so it tends to hold up better. But both, have broken the support and below their moving averages. So, we'll be watching for any sort of rebound. Of course, the most negative rebound will be a move back to their moving averages, and a 2 or 3 day rally that ends up in a failure. Same sort of thing for NYSE all. It's got some pretty good support. Not right at about where we are. Going down into the January lows right here. This the Nasdaq 100, or this is the Nasdaq Composite high low. See, only 72, so a big drop off in the number of new highs. That's not a positive sign, but typically we would see a breakout in the number of stocks making new lows. That would be a sign that the selling was heavier than you would expect when the Dow is down 1,000 points or so. And So we'll be watching this in the week to come in case it gives you any stronger, warning signs. If you look at the NYSE Composite, similar picture, declining number of new highs, but no pickup. 64. We back in November we had 200. So that's kind of the level we're watching there. In terms of growth and value, we got down to the support level, and now we're turning higher as expected. MACDs are still negative. So, the question is going to be, is this a part of the top building process for growth? If so, then we would look for this to move up into this range and then roll over and have to break below this low to, confirm a new downtrend in growth and an uptrend in value. Remember, when this is leading, growth is leading. When this is declining, then that's a good environment for value. And as we saw from that table, a performance, IWD, that's the value, was down 130, and the value of the IWD was down twice as much. Back to the watch list. It'll be going out with the video. Lots of weekly sell signals, no surprise there. The weekly buys are all in the inverse. SJB is a pro-share short high yield. And other than that, we have the dollar here, positive, TZA, and the Dow. We'll be looking at some of the overseas markets also have gotten hit, but like Hong Kong, South Korea are still positive. Also interesting to look at the Stark bands. You can see all these Diamond, EE are all below their Stark minus band. A sign that the market is extended on the downside. Doesn't mean it has to turn around next week, but it's in the low risk buy area. Now we would like to see some daily momentum signals to suggest there is a change in momentum. A condensed look at the sectors shows their number are still positive on a weekly and some on a 3-day. XLC, XLE, XLU, the real estate XLRE, XOP, which we're in, gold is still, and then ITA, the defense, we got into just before the war hit, which was good, lucky timing. USMV is a low volatility. It's only missing a 4-hour, so that looks pretty good. Newmont Mine, we got stopped out of our stock position there because it reversed pretty sharply. Still in this sort of environment, risk control is the key. In terms of the sectors, we want to focus on these RS charts. You can see energy still looks strong. Quite a rally here at relative performance. Materials, as we saw, got hit pretty good. Just crossed below the moving average, but not really enough, in my view, to suggest it's a top end in place. Same for industrials. They were down sharply, but still in a positive trend. Consumer discretionary we're still out of, and of course, a deeper correction will clearly reduce consumer spending, which of course is in line with the sharply higher gas and crude oil prices. Hopefully the winter is over. Otherwise, it could get even worse. Slight short-term topping action in the staples. Healthcare, longer-term trend still looks positive to me. The RS is still range bound. Financials, I keep thinking they're at the bottom, but so far not much. So, but they're ripe in this sort of sideways to down padding. We'll look for a sharp move above its moving average. They're down testing the yearly pivot, but I don't think have closed below it. Technology, trying to bottom, but not doing much, 16.7%. Adobe and Intuit are a couple of the few positives on a 3-day, and Microsoft actually triggered a weekly doji buy signal last week. So it is still here in the negative category. It's got a daily positive DTS, as do quite a number of the software stocks. Communications looking strong again. You can see it's the top half, bottom half. Top half here, Charter Communications, Netflix, etc. T-Mobile all positive, and then the rest of these guys are negative. And then lastly, the utilities. extended on the upside and less so in the real estate, but both are still positive. 91% here, 100% there. That's a pretty strong number, particularly compared to the 16.7% in the technology. I hope to update the whole list of ETFs and where they are relative to their yearly pivots. As I mentioned a month or so ago, looking for some of the lagging ETFs from the end of last year to find support around the yearly pivot level, and then some positive momentum. And these columns here shows you like the ARKW was negative as of February 20th, so those are the ones you'd want to stay away from. Cloud, I think, has improved now. Internet clearly got creamed, and I hope to get these out to go along with Monday's reports. Hope you found this beneficial, and as always, send me your comments, what you'd like me to talk about, and what I left out of the last one. Have a good week. It could be crazy again.